Ajay Srivastava, good morning. How are you doing, sir?
Good morning. Life couldn't have been better, right?
Yes, it's always the spirit which I always admire about you. So what should we talk? What should we start with? The lovely jacket and the inspiration behind this you're wearing? Your golf
Oh,
game
thank
and
you
your
very much.
handicap,
This is
or
a
how much money you've made in last 1 month? I'll give you three
okay.
options.
Okay. Give me the options.
No, I'm actually intrigued with this, with the jacket of yours. Early
Okay,
morning,
this is a
40
brand which
degrees,
I
you're
have
wearing a
invested
jacket.
in. Can you believe? It's a brand which I have invested called Givo, which strangely you'll find I've invested in a brand, a lifestyle brand. It's an Italian brand, so I've invested in that company and therefore proud to wear my own product.
Style of rich and famous, that's what I can say. India में बहुत brands हैं अजय भाई. Lot of good brands in India. How about investing in
Well,
Indian brand?
you won't find this jacket. You can try it.
Okay. What about markets? What's keeping you busy?
I think markets has been very good because it's rewarding your patience, it's penalizing your exuberance. The good themes are getting traction, the bad ones are getting revalued. So it's one of those markets where you kind of find pricing to almost perfection, and the euphoria is missing, pessimism is missing. You're being realistic about what you expect in the market, and more importantly, market is giving a lot of opportunities to book profits and put money in the bank. And I think it's a real good combo that you got good sectors like aviation, etc., handsome returns, hotel, handsome return. You got bad sectors which are like QSRs and others, and you got some interesting plays which I keep doing, which I keep saying that's the long term, which you keep buying minerals, metals. They've done a decent job. The profits will fall and rise, but they've been a good kind of mix of companies. So I think it's been a very nice story. No hiccups, no sudden drops, no sudden rises. Can't get better for an equity investor. Believe me, it's one of the golden ages I've seen after a long time.
So then why are you investing in an Italian brand company? Invest in Indian stocks.
That's a good point. I think as we age, we acquire madness, don't we?
You just mentioned and something what Avan, me and Aisha were referring to, that QSR, it's a great play that Indians will eat more, our calorie consumption is going to go higher. We've acquired more global taste in terms of eating a pizza and a pasta. But you said that those are expensive stocks and you are booking your gains there. Why is that?
It's been booked and because it's booked and gone long back. It's not the moment you realize that in an economy, the consumption story is slowing down. The discretionary consumption is slowing down. Whether we like it or not, higher interest rates are going to expand your EMI payout, leaving less money for discretionary. And we've seen very clearly that customers have gravitated towards putting in money in holidays, travel, more than cinemas, more than consumption, more than buying goods and services at the end of the day. I think QSR story is done for the time being for the two simple reasons. India's consumption story is going to go down this year with the EMIs expanding. That's one. And number two is that as you cut going out, the ability to buy in also less. And third, cloud kitchens. Now, those are killing this brand because I don't know if you have ordered, I'm sure all of you have ordered, Aisha have ordered. The cloud kitchen options are expanding by the dozens. You get some niche products, you get French, Italian, whatever it is, and very good offerings compared to standard fares of a Domino's or a Pizza Hut. And those are eating into the market share very quietly, steadily. So you really find that today when you go out, nobody orders a pizza from the regular two places. It's always a cloud kitchen, always a niche maker from whom the pizza is ordered if you go out somewhere or the food is ordered. So I think those are waging double whammy. They're not profitable. The scale is suboptimal. And whether we like it or not, at the end of the day, when you come back from abroad, you still want Haldiram Chola Bhatura.
Absolutely. Completely agree with that. Plus, I don't think we are the audience who would be eating, Domino's or Pizza Hut anymore. Nikunj,
Why
do
is
you?
that? Yeah, of course.
You do?
Once in a while.
Okay.
Oh, you don't eat?
Not Domino's.
Which one do you consume?
That doesn't say anything about the stock price. I'm just purely talking about the pizza.
Avan?
Yeah, like Ajay was saying, there's so many options.
No,
today.
first, you don't eat
You're
Domino's
not
pizza.
sticking to your traditional.
You don't eat Domino's pizza, that cheese pizza.
Not that often as one used to, and it was the only option, is what I guess.
Exactly. There's so many options.
Yeah, but
We'll order Chalo today.
Jubilant Foodworks has moved, and just to be a devil's advocate in defense of Jubilant Foodworks, they are diversifying. They moved into biryani, they moved into Chinese. For me, Jubilant Foodworks is a company which has the ownership of the supply chain, and can they scale up on that? I mean, Domino's Pizza is one of the businesses they are in. I'm not saying it's a good stock to buy, but to assume that Jubilant FoodWorks is only a pizza company, I think it's being unfair to them. Mr.
Yeah,
Srivastava?
we were just talking about pizza. We were not talking about company or stock.
Well,
Yeah.
you know, the question is, what are you buying at? You're growing, not even growing these companies. And the valuation is just crazy what people have bought the stocks and holding on to them. Why would you want to buy a P of 40 and 50 in a company which is almost growing at 0 or 75% single digits? You know, it doesn't make sense. And the beauty is, India is getting so many newer stories coming out. See, we just invested in a company which has done remarkably well, which was doing those lounges at airlines. Now, very niche and very profitable. Now, that's kind of stock which has done phenomenally well for us. We've seen a watch company which does fancy watches all over the India. So, also we have to gravitate away from, I keep saying, mass consumption driven companies to the companies which are catering to the rich of India, because India's K-shaped economy growth tells us that the rich of India is where the consumption play is going to be. So you see these airport lounge companies doing well. You see the expensive watch companies doing well. You see the airline doing well, expensive hotel doing well, but you will not find mass items doing well. And I think you will find that the mass retail companies are going to see the worst slowdown in April, May, June they've ever seen. And that will come to bear on whether it's Reliance stocks or it is the other retail stocks. Just watch what happens in April, May, June quarter. It's going to be a slowdown which market doesn't even understand happening in the market.
But that similar logic, Ajay, can be applied even to apparels, for instance. Everything from a Trent to ABFRL, Trent in particular, or even the Italian brand that you're invested in and sporting right now, all of them are sitting at rich valuations.
See, no, valuation is not rich. Unfortunately, Aisha, valuation is not rich. Look at ABFRL. It has never made money for anybody. For 10, 15 years, it has made no money for anybody, any stock. And for the market position, I'm short on that stock. I'm not saying negatively about it. But the fact is, they never make money. They're the best brands. They never make money. And therefore, one comes to a conclusion that when you cater to the mass market in India, either you follow the Indigo model, which is highly efficient, cost-effective model, or you are going to be, have a problem in the return. When you said Italian, as I keep saying, the expensive part of India is still buying and buying heavily. You saw the kind of prices in Mumbai. If I were to ever work in Mumbai, Nikunj, I wouldn't be able to afford a house in Mumbai. I don't know where I'll stay. Maybe I'll stay in Pune and drive to Mumbai every day. All right. So that rich segment of India, Aisha, is got serious money. It's spending those money today in India. And therefore, I believe anything which focuses on that segment is going to do very well in this year and next year and so on. Anything focused on middle market, below middle market level is going to have trouble times. So, I keep saying, whether we like it or not, it's not fair to the world. It's socially not equitable to say this. The fact is, Indians rich have never had it better than this, and they are spending money and showing it. So when I talk about my investment, I just focused and you say, talk to the guy who can wear a 15, 20,000 rupee jacket. I think they're abundant of them. You want a guy who wears a 4,000 rupee jacket, you're going to find a problem finding enough of them.
So apart from investing in high-end Italian menswear and fashion wear companies, where else are you investing?
See, I think we have reasonably invested in aggressive customer stories catering to the Cape market economy, as I mentioned to you, whether it's the airline lounge company, whether it's expensive watch company, whether it's airlines, whether it's hotels. I think India's story to us is restricted to that bit. And the large bit is the industrial companies. I think good or bad outcomes, company, whatever it is, the capex plan of the government is giving major boost to all these companies. And if you've seen history over the 7-8 companies in the sector, doing wonderfully well, deleverage, good order book. So industrial capital goods is the second largest block of our investment at this point of time after this discretionary luxury products.
Well, speaking of, that segment as a whole, Ajay, I bet if you're looking for a booking for the summer, you're spending a hell of a lot of money to get in these hotel bookings, etc., because prices have gone through the roof. You did speak about aviation, but just want to delve into this entire, hotel space as well. Where is it that you're sensing opportunity from the listed players?
See, there is, unfortunately, there is only one and a half listed player, if you ask me. The one listed player who is decently making money, which is, of course, we have a holding. So for disclosure, Indian Hotel. When I said half means, I never understood that why Oberoi Hotel, which is the most premium hotel, never made money all these years and still hardly growing. So, it's barely an investing proposition at this point of time. So India, unfortunately, doesn't give you any option apart from this and Lemon Tree. Where do you invest? Both are today have covered up a lot of value. I'm sure there is a lot of value. The only risk we see is that you need to take money off the table in the next 12 to 18 months because they are following the same strategy what the multiplex followed. Fleece the investor. Now, fleece the investor can go on for some time. It cannot go on for all the time. And when the demand dips, it will dip and it will dip such drastically they will not know where to go. So I still say if there is reasonableness in part of the hotel companies, price it reasonable, make a product reasonable, I think it's still a good buy. It's a long-term buy. If they follow the multiplex strategy of fleece the customer, I think 1 year you got to be out of these stocks because that's the longest runway they'll have for the next 6 to 9 months. Through this holiday season, through the marriage season, and then you are done with it at the end of the day. So I think you already got fair valuation in the stocks. If you want to invest now, you got to be very clear. It's not a 5-year story now. It's a 1-year story where you need to book off and get off the bike at the end of the day. Because this story is not going to end well, given the way the valuations are in terms of hotel room pricing, etc. You can do it up to a point. You can't do beyond that.
Okay, I'm curious, Ajay, to get in your take on this entire ONDC, foray into the food delivery space. It's a very mixed view. Some are saying yes, there's going to be massive competition, etc., for the food delivery platforms, and then the others are saying that you cannot have, as of now, an ONDC which is just about starting. If they cannot bear the delivery costs, etc., it is going to be a huge challenge for them to keep up with the likes of the other two players. Your take?
Of course, absolutely correct. You get used to it. You put an app on your phone, you get used to it, and you say, okay, people who do Zomato, people who do Swiggy, rarely do both at the same time. There's a lot of brand loyalty to that product that you get used to using an app, used to using a system, and the delivery. To get your delivery system going, they have taken years and hundreds of crores of rupees. You can't duplicate it. So I totally agree with that the strategy of ONDC to get into this delivery business is stupid. They should not do it. It is not required by the country. There are lots of other things they're doing correctly. They should focus on them. For this, they don't have the dollars to spend to compete with these two majors. And they will improve. It's not that existing guys are going to just sit quiet. They're going to also improvise, improve, and more importantly, they come up with lots of marketing schemes. You got a lot of marketing talent. You got innovation. You got advertising. It's just not about physical infrastructure. And I think it will be a doom for it. There is no threat of any kind in my belief with this. Now, whether these delivery companies reinvent the model for profitability is a different issue. But I don't think so. Entry of a third player on DC can do anything to these players. These are too well entrenched. Bottom line is your phone can only take so many apps. And these two guys have got your phone space.
Would you buy Zomato then?
Sorry?
Would you buy in the spirit that Zomato stock got whacked last week, ONDC, burgers are 30 rupees cheaper? Would you buy that?
See, as I said, you have to put, I keep saying, a bucket of new age stock. You cannot just sit on a Zomato, you cannot sit on a Paytm, you cannot sit on one stock. You need to buy 4 or 5, just like any other PE fund, and hope some of them perform. They are good business models. It's not the business model is not good. They just need to find a way to profitability, and they will get value. The problem with the stocks is the moment the price goes up, all the old investors want to sell. And therefore, if you are a new investor, you must be cognizant of that at every price increase, you'll find existing investors selling. You've seen that's happening in Paytm. Performance has been superlative, but the old investors keep dumping stock in the market. So the point is, you got to be invested in it, but build a portfolio theory and have ammunition to keep buying on correction, because correction will come, supply will come. It will take about 2 to 3 years before supply stabilizes out of the system, and you can get good returns out of it. And that's where Nykaa scored a little bit. It's gone down drastically, but it's still scored. It doesn't have too many shareholding in the public. The moment they start to sell, you'll find what happens to the share price. It'll be massacred. So I'm saying build a portfolio, do not buy one stock, and keep ammunition to average down, because 2 to 3 years down the line, some of these stocks are going to give you very healthy returns in the market. And they are now not going to be replicated. India will not have news stories of Swiggy and Zomatos for the long time, or a Paytm or a thing. So piggyback, build portfolio, add it to them when correction, and hold it for a 3-year period. I think it will give you very handsome returns.
We've seen a lot of these, small pockets. Like yesterday, we saw electronic manufacturing as a theme which got picked up. Do you think electronic manufacturing could do what railways and defense have done in the last 2 years for investors?
I don't think so, because intrinsically, Nikunj, the margins are so small. They're slim, less than single-digit margins in this industry. Now, even at highest of scales, you barely make any money at the end of the day. And to my mind, anything that is linked to government incentive plans is a no-go, absolute no-go. You don't know when it's going to change. A new audit will come. The CAG will file a complaint. You saw what happened to the electric EV two-wheelers. I'm not saying whose case is correct, but I'm just saying, look at the uncertainty you are sitting with. When you start to invest based upon government subsidy schemes, I think your starting thesis is wrong. If you invest based upon that the customer needs a product and the company can make a good return out of it, I think that's where you put your money. It doesn't matter to me, 4, 5, 6%, EBITDA margin. There's no businesses. There are trading opportunities. And for us to make equity returns out of such companies, far more difficult, I believe me, far more difficult. Why do it? This market universe is giving us so many better opportunities. So electronic trading assembly units, I think it's a no-go for us. And we have not missed anything out at the end of the day.
Okay, fair point. Appreciate your time. Thank you for joining us.
Thank you very much. You have a good time.
Thank you very much. Always a pleasure.